Welcome to the captivating world of sub-allocation, where the art of precision meets the science of investment optimization. In this segment, we'll take a closer look at how to strategically allocate your assets within each of the 5 buckets of digital assets. Just as the skilled painter carefully selects colors to create a masterpiece, you'll learn to fine-tune your portfolio by distributing your investments across various assets within each bucket. Sub-allocation is the key to maximizing the potential of each bucket while ensuring a balanced exposure to different assets. It doesn't matter if it's within your Hodl Bag bucket, Yield Bag buckets, or Moon Bag bucket. This topic will empower you to make informed decisions that align with your risk tolerance, investment goals, and market conditions. Let's embark on this journey of sub-allocation and discover how to strategically distribute your assets within each bucket to build a resilient and prosperous investment portfolio. In the realm of cryptocurrency investment, the Hodl Bag strategy is a widely embraced approach that involves holding onto assets for the long term. However, within this strategy lies the subtle art of sub-allocation, where the allocation to different assets within your Hodl Bag bucket evolves based on market phases. Let's delve into the intricacies of sub-allocation within the Hodl Bag strategy. During periods around the Bitcoin halving and bull market, the focus is often on assets with strong growth potential. Consequently, the allocation to stablecoins tends to be relatively smaller during these phases. Investors aim to capitalize on the upward momentum of the market and take advantage of potential price appreciation. As the market approaches its potential peak, a strategic shift occurs in sub-allocation. The allocation to stablecoins becomes increasingly significant. This allocation acts as a form of profit-taking, allowing investors to secure gains and protect their capital from potential market corrections. This phase acknowledges the cyclical nature of cryptocurrencies and positions investors to navigate potential downturns. Once the market enters the accumulation phase, characterized by prolonged price declines, the allocation to stablecoins may be reduced. This reduction reflects a shift in strategy to accumulate other cryptocurrencies at lower prices. During accumulation phases, investors often seek to identify undervalued assets with long-term growth potential. Sub-allocation within the Hodl Bag bucket highlights the importance of adapting to changing market dynamics. By adjusting the allocation to stablecoins based on the current phase of the market cycle, investors can potentially enhance their risk management and overall portfolio performance. Sub-allocation allows you to strike a balance between capitalizing on growth opportunities during bullish phases and safeguarding your gains during potential downturns. As you implement sub-allocation within your Hodl Bag bucket, consider the broader market context, your risk tolerance, and your long-term objectives. This approach enables you to proactively position your portfolio to weather the different seasons of the cryptocurrency market while aiming for sustainable growth over time. Within the realm of cryptocurrency investment, the staking bucket strategy offers a unique opportunity to earn additional yields while holding resilient cryptocurrencies. Sub-allocation plays a pivotal role in optimizing this strategy, allowing you to effectively balance risk and potential rewards. Let's dive into the intricacies of sub-allocation within the staking strategy. Staking involves actively participating in a blockchain network by holding and staking tokens. In return, you earn rewards in the form of additional tokens. When crafting your sub-allocation within the staking strategy, it's essential to consider the resilience of the cryptocurrencies you're staking. Blue-chip tokens like Ethereum are often preferred due to their established reputation and track record. Your sub-allocation within the staking bucket strategy should reflect your risk tolerance. If you're seeking lower risk exposure, consider allocating a larger portion of your staking bucket to reputable tokens like Ethereum. These tokens are generally considered less volatile and more resilient to market fluctuations. Just like with other strategies, sub-allocation within the staking bucket should adapt to the market cycle. As the market approaches its peak, a prudent approach might involve reducing your exposure to the staking bucket. This reallocation can be achieved by shifting a portion of your staking bucket allocation into stablecoins within the Hodl Bag bucket. By doing so, you enhance your ability to safeguard gains and position yourself for potential market corrections. Remember that sub-allocation within the staking bucket strategy is about aligning your portfolio with your risk preferences, financial goals, and market conditions. By thoughtfully managing your allocations, you can harness the potential of staking rewards while navigating the ebbs and flows of the cryptocurrency landscape. Lending opportunities come with varying degrees of risk, which should be a crucial consideration when designing your sub-allocation. Stablecoins, for instance, typically offer lower risk lending options with interest rates around 4% annually. On the other hand, tokens like synthetics, which offer around 6% annual interest, carry higher risk due to their volatility and potential market fluctuations. When creating your sub-allocation, understanding and balancing these risk profiles is essential for optimizing your lending bucket. Your sub-allocation strategy within the lending bucket should align with your desired risk exposure. If you prefer a more conservative approach, allocating a larger portion of your lending bucket to stablecoins can provide a consistent income stream with relatively lower risk. As with other strategies, sub-allocation within the lending bucket needs to adapt to the market cycle. With the market nearing its peak, consider adjusting your lending bucket. By reallocating a portion of your lending bucket assets into stablecoins within the Hodl Bag bucket, you can safeguard profits and enhance your ability to navigate potential market downturns. This shift positions the Hodl Bag bucket as a stabilizing force during market fluctuations. Your sub-allocation within the lending bucket is a balancing act between risk and potential reward. By allocating more of your lending bucket to stablecoins, you prioritize consistent income and lower risk. Factor in the cyclical nature of the market when adjusting your sub-allocation and consider the potential benefits of enhancing your Hodl Bag bucket allocation during market peaks. In summary, navigating sub-allocation within the lending bucket involves strategic risk management and optimizing your potential for income generation. By thoughtfully assessing risk profiles and understanding market dynamics, you can tailor your sub-allocation to align with your financial objectives and risk tolerance. The pool bucket presents an enticing opportunity to generate income by providing liquidity to decentralized exchanges and other platforms. As you embark on sub-allocation within the pool bucket, understanding the diverse risk profiles associated with different pool options is paramount. Let's explore the nuances of sub-allocation within the pool bucket. Pooling your assets comes with varying levels of risk depending on the specific pool you engage with. For instance, participating in an Ethereum-wrapped Bitcoin pair may offer around 35% annual returns, with a relatively lower risk profile. This pair involves established assets that provide a degree of stability. On the other hand, venturing into more dynamic pools like Ethereum Uniswap pairs, with potential returns of around 60% annually, carries a higher risk due to the nature of the assets involved and the potential for market volatility. Furthermore, considering pairs like the Ethereum GMX pair, which can yield over 200% annually, necessitates close monitoring and understanding of the underlying asset's behavior. Similar to other strategies, sub-allocation within the pool bucket should be influenced by the prevailing market cycle. As the market nears its peak, you may contemplate adjusting your pool bucket portfolio. Shifting a portion of your pool bucket assets into stablecoins within the Hodl Bag bucket can be a prudent move to capitalize on potential profits and shield against market fluctuations. As the market approaches its zenith, consider the strategy of bolstering your Hodl Bag bucket allocation by reallocating a share of your pool earnings. This approach safeguards and fortifies your overall portfolio, allowing you to harness the potential of stable assets during market downturns. When crafting your sub-allocation within the pool bucket, the emphasis lies in balancing potential rewards with risk management. Allocating more of your pool bucket to established pairs can offer consistent income and moderate risk. Meanwhile, dynamic pairs may provide higher returns but require a vigilant eye and ongoing analysis. The market cycle remains a key consideration when adjusting your pool bucket sub-allocation. The strategy of reinforcing your Hodl Bag bucket allocation during peak market conditions contributes to the overall resilience of your portfolio. In conclusion, navigating sub-allocation within the pool bucket involves a strategic approach to risk and reward. By comprehending diverse risk profiles, aligning with market dynamics, and emphasizing your Hodl Bag bucket allocation, you can design a sub-allocation strategy that aligns with your financial goals and risk appetite. Diving into the Moon Bag bucket is akin to exploring the frontier of high-risk, high-reward investments, where innovation and potential exponential growth take center stage. This bucket is akin to venturing into the realm of startups, where success can be exhilarating but also unpredictable. Let's navigate the intricacies of sub-allocation within the Moon Bag bucket. Unlike other strategies with more established assets, the Moon Bag bucket is driven by your information edge and foresight. Crafting your sub-allocation strategy within the Moon Bag bucket requires a blend of intuition, research, and risk management. As you delve into projects with potential for exponential growth, remember that market timing and a deep understanding of each project's fundamentals are essential. Similar to other strategies, sub-allocation within the Moon Bag bucket should be informed by the prevailing market cycle. As the market advances toward its zenith, a tactical approach involves reducing the Moon Bag bucket allocation and reallocating funds to the Hodl Bag bucket's stablecoins. This reallocation enhances your portfolio's overall stability and positions you to capitalize on potential profits. Ultimately, as the market evolves, adjusting your Moon Bag bucket sub-allocation becomes a key strategy to optimize your portfolio. Shifting from Moon Bag bucket assets to the Hodl Bag bucket during market peaks fosters a robust financial approach, aligning with your goals while mitigating risk. In essence, the Moon Bag bucket is a journey that demands both adventurous spirit and strategic acumen. By effectively navigating projects, harnessing your information edge, and adapting to market cycles, you can harness the Moon Bag bucket's potential while fortifying your overall investment strategy. Now that you've delved into the world of creating sub-allocation, it's time to transition to our next lesson: importance of monitoring. This shift takes you from the realm of strategic planning to the dynamic arena of ongoing vigilance. Just as a captain steers a ship through changing waters, monitoring your portfolio ensures that your investments stay aligned with your goals and market conditions. From tracking performance to adapting to evolving trends, this lesson equips you with the tools to transform your approach from a one-time strategy to an agile and informed journey. Get ready to explore the significance of staying vigilant in the ever-changing landscape of crypto investments. Let's navigate through the importance of monitoring your portfolio. Dear viewer, before you skip, please note that this free course was brought to you by NovaDash. NovaDash is a non-custodial digital asset management tool that lets you manage all your crypto assets in one place. Build, manage, and monitor your Hodl Bag, staking, lending, liquidity pools, and moonbags with just one click. Visit novadash.io for more information and follow us on our social media channels.